that are joining us. Mr. Umesh Revankar from Shriram Finance is also joining us now. Mr. Revankar, thank you very much for your time here on CNBC TV18. No repo rate cut, but a 50 basis point cash reserve ratio cut like the markets was, expecting. Start by telling us what is the impact on, lenders like Shriram Finance.
Yeah, basically, I felt that the status quo would be continued because of the inflationary numbers which have been there for last couple of months. And yes, the CRR cut is a welcome step because some liquidity will be there in the system. I think the government spend will start now, and with the CRR cut, there will be more money will be available for the infrastructure development, and that is going to give a lot of opportunity for other businesses, because when government spends, there are so many other businesses get an opportunity, like contractors, subcontractors, and new employment. All those things happen. And I believe that this is the right time, little more liquidity comes into the system and helps the growth, because we definitely feel that there is a growth opportunity coming up in the this quarter and next quarter.
Okay, Mr. Revankar, we had some of the other panelists earlier talking to us about the FCNR deposit, a ceiling being raised by about 200 to 300 basis points over what banks were already offering. This is for a limited period, of course, until March of next year. Is this going to make this deposit segment marginally more attractive? Do you think it'll move the needle?
I cannot really comment on the bank deposit growth, but I feel bank deposit growth is already in positive, in the sense there has been improvement in bank deposit, especially in the last couple of months, and making a little more attractive for various deposit definitely is a good sign. Plus, because the government banks do need additional resources for lending the growth. So I think that is definitely a positive one.
And what about your cost of funds, Mr. Revankar? How do you expect that to pan out? Repo rate for now staying put at 6.5%. Some liquidity, of course, coming in for the banking system.
I think banks will definitely now push for growth. There has been some slowdown in bank credit, and bank will find new avenues for lending. And also, being the one of the intermediary part of the financial system, the NBFC industry also will feel that will be more resources coming to the NBFC for the last mile reach.
Mr. Revankar, a larger comment on, the lending rates as well, with repo being left where it is. Just tell us, what are the sectors where you're seeing some pickup as well in credit, sort of demand? With the kind of GDP forecast that the RBI is given at 6.6%, where are you seeing pickup?
The basic, my sense is that the pickup will come from the government spend, basically, and whether it will come back into real estate in a big way is question mark, because the real estate to really grow, what is needed is indicator of rate going down, because the borrower, the housing borrowers prefer to borrow at lower rate. That indication is not really there. So basically, I feel the infrastructure-led spend is more important right now, and those industries which is linked to the construction infrastructure will see growth.
So you're expecting a credit growth in these segments despite the lower GDP forecast that we have now from the RBI.
The lower GDP numbers, basically what happens is the rain slowed down in August, and September is the full month for the mining infrastructure activity. This time around, the rains were there till the September end. So last quarter number may not be the reflective of the economic growth or but the RBI has brought down the numbers to 6.6. that may be a long-term trend. So 6.6 GDP growth is a good enough growth for the economy to grow and for credit demand.
All right, Mr. Revankar, before we let you go, quick word on what happens to your lending rates going ahead from here.
We were really not really expecting a change in the lending rate. So the lending rate will remain at present level, and our net interest margins also will remain at present level. So at least for a couple of quarters, till there is a significant change in the environment and maybe the RBI's outlook. And unless the repo rate comes down, I don't really see. The CRR cut will only help higher liquidity in the system, but it doesn't really help in reducing the rates.
Yes, Mr. Revankar, thank you very much. So until there is a cut from the RBI, you're hopeful of protecting your margins and, of course, your lending rates. You do not see any material changes. Thank you very much for joining us on that with your take.
For more news and updates, all you need to do is follow CNBC TV18 on all of our digital platforms.